Will it be sell in May and go away or back to all-time highs? Let's go. After one of the worst weeks that we've had in a while, being last week, the market surely bounced with earnings. And I'm pretty sure many traders are asking if they should buy the dip and wondering what's ahead. Let's start to dig into that and more by looking at a heat map of the weekly. What I'm finally starting to like about this chart is you're seeing a fair amount of green, but it's not necessarily all green. It's a pretty good mix. Let me explain. As money rotates, as I discussed in last week's video, longer term, this can allow the rally to continue. And we saw a lot of big tech recover this week. And as some of the other sectors end up taking a breather, this then allows big tech to cool while some of these other stocks start to participate again. And of course, when I said big tech rebounded, that was the exception of Meta, as they posted a double beat on earnings, but they were crazy enough to say that they had to spend money on AI and likely that was going to take time. I think all the other companies know this, but they said it. Banks once again did well this week, and when we look at the Russell later, you'll see that this was both the big and small varieties. And why not? Because at this point in the earnings cycle, we've had a ton of companies already reporting, and over 80% of companies have beat their estimates. When we flip over to the percentage of S&P 500 stocks trading above their 20-day moving average, this tail candle that I mentioned last week, it saw follow through with participation to the upside. So the next question on everybody's mind is, are we going to see more participation and breadth expanding next week, or are we going to go ahead and see some type of corrective wave reversal? We'll dig into those details in a bit. And last week when we looked at the percentage of S&P 500 stocks trading above their 50-day moving average, we discussed how this tail candle was likely to see market breadth improve, and it did. So the question is that this 5 EMA, as we've seen in the past, will this act as resistance? And will we get rejected going into next week or break through? And was this nothing more than a pullback? Now ask yourself, can you think of any catalyst that could reverse the market next week, like the interest rate announcement? Let's face it, it's a foregone conclusion that there's going to be no rate cuts, but much depends on Jerome Powell's tone and whether all cuts are gone this year or a potential exists for at least one or two. So that will be a really important meeting on Wednesday afternoon. As we look at the SPY weekly and dig into a little bit of the daily, I think it's going to start to help us answer some of these questions about where we're going next. The first thing that you'll notice is I kept my ABC corrective wave that I thought the market was going to do going into last week. I was expecting a bounce as we held this 20 simple moving average, and that's exactly what we did. And a 2.5% bounce certainly made traders feel a lot more steady Eddie after selling off last week. Now we'll go into a little bit more detail of what I'm expecting next in this corrective wave. But one thing for sure is that if we get above this golden pocket area here, then likely this was a pullback and we're going to have no corrective wave. Remember, pullbacks of 5 to 10% are normal, and corrective waves usually go a little bit deeper in the 10 to 20% variety. With all the earnings and Fed speak next week, as well as job stuff on the calendar, I'm expecting next week to be volatile, as that's what corrective waves do. They try to shake out traders. If we flip over to the daily briefly here, we can see that last week I spoke about how we were likely to bounce into this wave 4 before heading lower into this wave 5. And then that would allow us to start entering this corrective wave next. And that's exactly what we did. Now, one thing that I modified on this chart is that I was expecting us to go ahead and undercut this low, but instead we had truncation. Now, truncation for wave 5 is a real thing and allowable by Elliott wave rules. So right now, likely we are in a corrective wave, and these have a tendency of being messy because an A wave up and then a B wave down and then a C wave up. This will shake traders out of trades because, one day they're up, one day they're down. So many times in this environment, I'm just buying the dip and selling the rip versus holding positions overnight. Also, as we go through earnings, depending on what the expected move is for the straddles, I'll go ahead and buy a put in the call at the money with an expiration out a week or two. And this allows me to avoid a little IV crush while making some money on moves that are greater than the expected move. Now, as I mentioned earlier, if this was just a pullback, we'd likely see a wave 1 coming up into this area, a wave 2 coming back down. And then, of course, this wave 3 would be impulsive. And instead of, ending it here and then heading lower, if we end up breaking through that golden pocket area, only to start moving into new all-time highs in an impulsive fashion, then this was just a pullback of 5%. The one thing I caution traders on is that this corrective wave of going up and down through here and whipsawing traders out of positions, this often goes on for longer than I'd like. And at this point, we're probably going to see a lot of traders try to line up shorts in this area, as the risk to reward for a short is very good. As to get stopped out of this position, it's very clear and definitive. But getting above this is the same exact thing, will allow this to squeeze into an impulsive type behavior. If you're finding all of this helpful, then go ahead and subscribe, or better yet, join the Discord, where I help give traders what I'm thinking about before open and after close, as well as all my algorithm signals on over 70 equities with my feedback on whether I'm entering or staying on the sidelines, as an algo can't account for everything. And briefly, let's flip back to the weekly. As last week we had a MACD cross, and this week we confirmed it by moving lower. In general, this type of move takes a long time, and being that we confirmed it, this isn't exactly bullish. That is why when I'm trading corrections, I just make sure to either play straddles, like I said earlier during earnings, or take profits a little bit more quickly than normal, as I don't want to turn a 4% winner like I had today on Palantir that opened yesterday into a stinker. The Qs this week are looking similar to SPY, as we saw a buy on greater than average volume this week. And for the most part, it was able to reclaim all the moving averages except for that pesky 5 exponential moving average. Also, one thing to note is, we talked a couple weeks ago about this pennant and breaking out. Coming back into an area of a breakout and retesting before failing is typically a short opportunity. Also, we had a MACD cross a few weeks ago on the weekly, and we still see that momentum is waning. Many tech earnings are on the calendar for next week, and of course, these will be moving the tape in one direction or another. So far with tech earnings, we're seeing that stocks that have moved the least or not at all get rewarded, and the laggards get boosted. Netflix and Meta have moved a ton and got punished for double beats, whereas Tesla got pumped on a double miss, Alphabet pumped on a dividend, and Microsoft, well, it's Microsoft. And now turning our attention to the Russell, we see that it did bounce off this weekly 50 exponential moving average. And not only did it come into this area of a confluence of moving averages and the top of range that we saw for this ETF for quite some time now, and just like the Qs, coming back into an area of resistance and retesting, where you broke out only to fail is normal market behavior. So the Qs and IWM are telling us that we got to watch this area, because there could be, more downside to come before moving higher. Once again, if we just break through this area, then happy days are here again. But I wouldn't be surprised if, we go a little bit higher or move sideways going into next week. US 10Y yields pressed higher. And of course, this is never good for equities, but we did move higher, which typically doesn't end well for equities. But this week we saw a doji candle, which of course indicates indecision. And this candle makes a lot of sense as we go into the Fed interest rate announcement, as we get a sense for the Fed and his anticipated moves as we go into the end of the year. The market, after listening to him, will decide if rates are going to get rejected or we're on our way to likely 5%. Last week we saw this beautiful tail candle on the VIX. And my hope was that we got rejected, and that's exactly what we did this week. But you'll notice here that we're holding this purple line, which is the 200-day simple moving average. And if we were to go back in time looking at this line, we'll see that when we're below this line, the stock market was feeling bullish. And if we're above this line, we're feeling bearish. So it wouldn't be unusual for the volatility to increase here, forming a right shoulder before failing. And of course, if volatility is increasing, that means the price of equities are dropping. As I mentioned earlier, this week with Fed Chair Powell in his press conference, this is certainly going to move the tape in one direction or another as we try to understand his tone and how many cuts are priced in for the remainder of the year. And also this week, there's a lot of job data, which could move the tape as well. And let's not forget earnings, as there are quite a few important stocks on the docket this week, as this will give MMs excuses to sell high-priced stocks and buy low-priced ones. Look, I could have given you a clickbait telling you how the market was going to crash like other YouTubers, but instead, I'd rather give you the info you need to be successful. So check out the video here to see how I explained all this was going to happen last week, as that's all I have for now until the next video, and we'll see you then.